good afternoon, good evening, class. My name is Felix Torres, and today we're going to be talking about financial management and sensitivity analysis in capital budgeting. When we talk about financial management, the primary goal is clear. It's to maximize shareholder wealth. In simple terms, this means ensuring the company's value grows steadily over time, which benefits not just investors, but the organization as a whole. Now, this doesn't happen by accident. It requires making strategic choices that balance the need for short-term gains with the reality of long-term sustainability. A good financial manager has to walk a fine line. Yes, you may not see the opportunities that look profitable right now, but if those decisions awaken the company's stability down the road, they can do more harm than good. That's why risk assessments play such a significant role, because maximizing wealth isn't just about chasing profits. It's about protecting the health of the company for the future. To achieve this goal, financial management performs four key functions. First, investment decisions involve deciding whether to allocate the company's money so that it earns the highest possible return relative to the risk. Second, financing decisions. Here, managers decide how to fund those investments, whether to use debt, equity, or a mix of both while balancing costs and risks. Third, dividend decisions. Should profits be returned to shareholders as dividends or reinvested in the company for growth? That's a critical call because it affects both investor satisfaction and the company's future. And finally, liquidity management, ensuring the firm has sufficient cash to pay its bills today while also maintaining the flexibility to pursue new opportunities tomorrow. Together, these four functions form the backbone of financial management. One of the most essential tools in financial decision making is sensitivity analysis. This is a technique that tests how changes in assumptions affect project outcomes like net present value, often called NPV, or internal rate of return, IRR. Think of it like stress testing a financial model, which happens if sales drop. What if raw material costs go up? What if the cost of borrowing money changes? Sensitivity analysis helps managers pinpoint which assumptions matter most and prepares them for the uncertainty before it becomes a problem. Now, quantitatively, sensitivity analysis follow a step-by-step process. It begins with a base case scenario, which represents the company's best estimate using expected assumptions. From there, one variable, such as the sales price, cost of capital, or production costs, is changed, while everything else remains constant. After each change, financial metrics such as NPV or IRR are recalculated to assess the impact. Finally, the degree of sensitivity is measured, often by calculating the percentage change in outcomes. This process enables managers to identify exactly which variables are most critical to the project's success. But numbers don't tell the whole story. That's where qualitative sensitivity analysis comes in. Here, managers step back and ask, are these assumptions realistic? Can the company adapt to changing conditions? For instance, could it handle rising costs or lower sales? Beyond that, managers look at market and industry trends, such as whether consumer demands are shifting or new competition is emerging. Expert judgment also plays a significant role here. By combining human insight and numerical models, companies gain a more comprehensive understanding of risk. Internal financial methods are another way to assess risk. These are tools the company builds from within. Scenario analysis, for example, allows managers to examine best case, worst case, and most likely outcomes. Simulation models like Monte Carlo analysis take it further by generating thousands of possible outcomes to capture the full range of risks. Break-even analysis identifies the exact point at which a project stops losing money and starts making a profit. Together, these internal methods highlight the financial vulnerabilities of a project and give managers valuable insight into resilience. Of course, not all risks originate within the company. External methods focus on factors beyond the firm's control. For example, market risk analysis examines demands, pricing, and competition, factors that no company can fully control. Industry benchmarking compares a project's performance against that of its competitors, helping managers assess their competitiveness. Economic forecasts offer a comprehensive view of broader economic trends, including inflation, interest rates, and overall growth. And finally, Regulatory analysis highlights the impact of new laws, policies, and compliance requirements on cost and returns. These external perspectives provides managers with a broader lens to identify potential risks. Finally, in capital budgeting, the process of planning long-term investments, it's crucial to integrate both sensitivity analysis and risk assessment. Internal models help identify financial weak points, while external analysis capture the unpredictable environment in which companies operate. When combined, they provide managers with a comprehensive view of risk. And with that knowledge, managers can allocate resources more strategically, create contingency plans, and ultimately make smarter, more informed investment decisions. And this concludes my presentation on financial management and sensitivity analysis and capital budgeting. Thank you and have a good evening.